Let's be honest, investing can feel like you're on a perfectly calm sea one minute, and then bam, you're in the middle of a hurricane the next. That economic uncertainty is always out there. But what if you had a roadmap? What if you had a guide? Well, today, that's exactly what we're building, an investor's guide to preparing for a potential recession. We're going to dive into the warning signs the pros watch and the actual strategies they use to protect their money. So let's jump right in. All right, here's what we've got on tap. First up, we'll look at the economy's flashing warning lights. Then we'll break down the two major types of risk you absolutely have to know about. After that, we'll get into the two main ways to analyze the market, see how the big money players move when they get nervous, and then talk about how you can design a defensive portfolio. And we'll wrap it all up by looking at the big picture, your long-term wealth plan. Okay, so first things first, before you can even think about building a fortress around your portfolio, you've got to know when the storm clouds are gathering on the horizon. This first part is all about learning to read those signs. The million-dollar question, right? Here's the most important thing to get your head around. The stock market is a forward-looking machine. It tries to predict the future. It leads the economy. It doesn't just react to it. That's why smart investors don't just wait for the news to tell them a recession has started. They're constantly on the lookout for a few key indicators. Think of them as early warnings. Let's look at 3 of the biggest ones. First up, we've got something called the SOM rule, and it's a fantastic canary in the coal mine for the economy. Now, why does it work so well? Well, think about it. Corporations always try to get ahead of a downturn, and one of the first things they do when they see trouble coming is tighten their belts, which unfortunately often means layoffs. The SOM rule is basically a very precise mathematical way of spotting that trend right as it begins. And historically, when this thing triggers, a recession is either already here or right around the corner. And building right on that, we have the bigger picture of unemployment. So it's not just one specific rule. Professional investors are watching the monthly unemployment numbers like a hawk. When you start to see that number tick up, not just for 1 month, but for a few months in a row, or when the government starts revising past job numbers downward, well, that's a huge red flag. It tells you that the little tremor the same old rule picked up on is starting to feel like a bigger earthquake. The economic engine is definitely losing steam. Okay, next up is one of the most famous and honestly one of the most reliable predictors out there, the inverted yield curve. It sounds complicated, but the idea is simple. Normally, you get paid more interest for lending your money for a longer time, right? A 10-year bond should pay more than a 2-year bond. But sometimes that flips upside down. The short-term bond starts paying more than the long-term one. And you have to ask yourself, why on earth would that happen? It happens because the market is screaming that it expects the Fed to slash interest rates in the near future, and the only reason the Fed would do that is to fight off a recession. It's a massive vote of no confidence from the bond market, and its track record is frankly incredible. Okay, so now we know what warning signs to look for. The next step is to understand what exactly we're protecting our portfolios from. See, not all risks are created equal. You've got 2 fundamental types, and you need to know the difference. First, you have what's called non-systemic risk. The easiest way to think about this is it's a localized problem. Remember when Toyota had that massive recall over sticky gas pedals? It was a disaster for Toyota's stock, for sure. But did it tank the entire market? Nope, not at all. The rest of the S&P 500 just kept on chugging. Same thing with the BP oil spill. It was catastrophic for BP, but it was their problem, not a problem for the whole market. And then you have the big one, systemic risk. This isn't a localized fire. This is when the whole forest is burning. The perfect and most painful example is the 2008 financial crisis. It didn't matter if you owned stocks in banks, tech, or manufacturing. When that subprime mortgage house of cards came crashing down, it created a domino effect that took the entire global financial system with it. This is the kind of risk that gets everybody, no matter which stocks you own. So here's the key takeaway. You defend against these 2 risks in completely different ways. Non-systemic risk? You can fight that with diversification. Don't put all your eggs in one basket. It's kind of like getting a flu shot. It protects you from a specific individual bug. But here's the thing. Diversification does absolutely nothing to protect you from systemic risk. When the entire system has, say, heart disease, a flu shot isn't going to do you any good. You need a totally different game plan. So how do investors come up with those game plans? Well, they generally use 2 main schools of thought to analyze what's going on. Think of them as 2 different but equally important sets of tools in the toolbox. The 2 approaches ask totally different questions.
Fundamental analysis is all about the why. It's the detective work. It looks at the big economic picture, government policy, demographics, company profits, to figure out what is likely to happen. Technical analysis, on the other hand, is all about the when. It ignores all that big picture stuff and focuses only on the charts, on price movement, on patterns, on investor psychology. It's trying to figure out when a big move might actually happen. To be truly effective, you kind of need to use both.
Okay, this brings us to a really cool and practical idea. So what happens when fundamental analysis says a recession might be coming and technical analysis shows that the market is getting scared? Well, the big institutions, the smart money, they don't just sit on their hands. They start moving their billions of dollars around in a very predictable way, and this is called the Great Sector Rotation. So here's how that money flow basically works. When the economy's booming and everyone feels aggressive and optimistic, money just floods into offense. High growth, exciting sectors like tech and financials. But the moment those warning lights start flashing, sentiment shifts from aggressive to defensive. Money rotates out of those high flyers and into things like consumer staples, utilities, and healthcare. And why is that? Simple. Because even if we're in the worst recession ever, people still need to buy toilet paper, they still need to turn their lights on, and they still get sick. These are recession-resistant businesses. This quote just nails it. This isn't some secret Wall Street conspiracy. It's a well-known playbook that the huge institutions use to protect their capital when they sense trouble. So by watching where the money is flowing, from offense to defense, you can get a real-time signal of how the biggest players are setting up their chessboard for what's coming next. Okay, we've spotted the risks, we've seen how the pros play defense, so how can an individual investor like you or me actually apply this stuff? Let's switch gears from theory to practice and talk about building a portfolio that can take a punch. Having a disciplined routine is everything. This checklist is a great way to think about it. Step 1 is basically triage. Manage what you already own. Stop the bleeding first before you do anything else. Step 2 is awareness. Keep your finger on the pulse of what's happening. Step 3 is all about patience. Don't rush into anything. Wait for the fat pitches. And step 4 is the strategic check-in. Look at your long-term plan and make sure what you're doing today still makes sense for your goals. So what does that look like in practice? Here are a few concrete ideas. You can use ETFs to get broad exposure. But here's a really smart one, the picks and shovels strategy. Think about the old gold rushes. Who got rich for sure? Not always the miners, but the guys selling them the picks and shovels. The same idea applies today with a huge trend like AI. Instead of betting on which AI company will win, you can invest in the stuff they all need. For instance, AI servers create a ton of heat, so companies like Vertiv, which provide the cooling systems, are the picks and shovels. All that AI data needs super fast networking, which is what companies like Arista do. It's a way to invest in a trend without taking on as much direct risk. And of course, always focus on cash flow, with good, solid dividend-paying stocks. All right, let's pull the camera all the way back now, because preparing for a recession isn't just about what you do for the next 6 months. It's really about building a long-term philosophy that can handle any kind of market. It's about having a real long-term wealth plan. This concept, made famous by Rich Dad, Poor Dad, is a total game changer. Let's forget all the complicated jargon for a minute and make it super simple. An asset puts money in your pocket. A liability takes money out of your pocket. That's it. The whole game of building long-term wealth is just this, using your money to buy assets, things that generate even more money, like stocks that pay dividends or rental properties. Your goal is to build a personal cash flow engine. So what do you need to build that engine? Well, it really boils down to 2 things. First, you need buying power. You need cash or access to credit to actually go out and buy the assets. But second, and I'd argue this is even more critical, you need financial education. You need the knowledge to know a good investment from a bad one. You need to understand how money actually works so you can spot opportunities that everyone else is too scared to see. This quote from John D. Rockefeller just says it all. Market crashes and recessions, they're gonna happen. It's a guarantee. For people who are unprepared, they're a total disaster. But for the investor who is educated, who has a plan, and who has some buying power ready to go, those disasters are actually the moments of greatest opportunity. It's when the best assets on the planet go on sale. And so that's the question I want to leave you with. Take a look at your own strategy. Is it built to just react, to get whipsawed around by every scary headline you see on the news? Or is it built on a solid foundation, structured to last for the long haul? because building that long-term structure, that's the real key to navigating not just the next recession, but every market cycle the future throws at you.